Good morning. Today is Monday, August 7th. I hope everyone had a nice weekend. If you are local here in Charleston, I hope you were kicking it inside with the AC blasting as we're in August, and August in Charleston is like living on the surface of the sun. Hopefully, some of you guys are up north enjoying maybe some cooler weather. We have a jobs report and a debt downgrade to talk about today. Um, July jobs numbers, economy generated 187,000 jobs compared to the 200,000 that were expected. And then that report included downward revisions to two prior months, totaling just under 50,000 jobs. Uh, Wage growth, as shown by average hourly earnings, remained solid for the month, indicating that the slowdown in hiring is a reflection of a tight job supply. So, what does this mean? Two Fed officials both kind of confirmed or indicated after the report that um, the Fed should be shifting from, do we raise rates to how long do they need to remain at current levels? So, we'll see here in the coming months what's going on with interest rates. It sounds to me like they should remain steady here for how long? Who knows? We'll see. Um, the US debt downgrade was this was kind of fun to research. I would say be careful what you read on this front. Our office tries to steer clear of the political, strictly look at data and what's actionable. But it's like the political part of this is like funny to read because if you go to the left news sources, you're gonna hear it sounds like Fitch with the U.S. downgrade from AAA down to or AA plus. Um, it's like they called their baby ugly. And if you go to the right wing media, you're gonna see how the world's ending. It's mind boggling how different this story's been reported by so many different people. But just a couple of facts that we can take from it. So the debt to GDP ratio, which is a measure of solvency, is at 120%. Just for reference, in 2008 or prior to 2008, it was between like kind of fluctuating between 35 and 65%. During COVID, it shot up above 100, and it's kind of remained there since. Um, so it isn't to say that the downgrade is without reason, because there clearly is some reason. Um, but what we like to look at is what did markets do? How did markets respond to said news? And I think it's evident. We saw it post 2008 that markets have just lost faith in the credit rating agencies because the markets kind of operated business as usual. It was treated this as a non-factor. Markets are very forward-looking, so the likelihood of a U.S. debt default, according to markets right now, is that whether Fitch left the rating at AAA or downgraded it, it's not really an indicator as to the likelihood of it happening. Is kind of how markets responded. Um, so just to reiterate, please be careful what you read on this front because there's a lot of there are a lot of slants and sides to this particular piece. Um, Last thing, and I would say the most fun thing from this video, fall reviews are coming up next month. We will be emailing out the scheduling link this week for the first time. Just follow the link to schedule your review and the time slots there. We're going to do them kind of the middle of September to middle of October. And then just a reminder, like these reviews aren't mandatory by any stretch. I know some of you only want to talk to us once a year. We'll have a note in the email when we send it out, but just if you're either too busy or you don't think your situation necessitates a second review this year, just shoot us a quick note. Hey, thanks, but I'll see you guys again in the spring. That'll be good for me. So have a great week, and we'll talk soon.